Good morning. Can you hear me, Nick? Good morning, Gus. How you doing?
Onda.
Mic check 1, 2, 3. Yep, cool.
Do you hear me okay?
BT, we've got you loud and clear. We are unable to see you.
You can't see me? That's probably good for you.
Bottom left corner, start video.
There we go.
All right, never mind. Go back.
Rather it the other way?
Yeah.
What's up, Evan?
What's going on? Good morning.
Hey, Bernie Pitroff.
Hey,
How you doing?
I'm good. How are you?
Hanging in there. Hanging in there.
I watch your calls while I get on the Peloton, so I'm gonna take off the video soon.
Well, no, you know what? You'll inspire us. Leslie's waiting for hers. I think Leslie gets. When do you get yours, Leslie?
Next week.
Oh, so you and I have to get on a challenge though. So what we do, if you click on the challenge button, you see who can ride the most miles.
I'm in. I'm in any competition and I'm in.
Let's do it.
I've been waiting 6 weeks.
Yeah, it's crazy. I know I've got a bunch of friends who's getting it. And when I bought it last year, I ordered it on Friday and got it on Monday. And now it's taking like so long. I mean, everyone's getting them.
Yep.
I hope the Civic boys behave. I see Matt Flores and Helfrich on the call.
Define behaved.
Oh boy.
What's up, Daniel?
Yo, what's going on, Jack?
Good to see you, man.
Good to see you.
I like that background.
Thanks. Yeah, it's one of those virtual digital ones. It's not really what I'm obviously sitting behind or in front of. Mr. Nyholt, what's going on? How's the desert? Awesome. I think you're muted. There you are.
No complaints.
Yeah.
I think they're going to open us up a little bit soon, so we'll see.
But the pool's opening up soon, I hope.
They are.
Nice.
They are open now.
Good.
Yeah. So
How's Crystal doing?
working like a dog.
Yeah.
Yeah. They just keep her moving all the time.
Yeah.
So how are you?
We're doing good. We're busy. We're cranking. Rates are back down to these silly numbers again, which is keeping the pipelines healthy. So it's belted now every single day. And unfortunate to be pretty.
Daniel, your audio is not very good.
Let me 1 second. I'm gonna mute everybody real quick.
Okay.
All right. How about now? If someone can give me a quick sound check, any better or worse?
Much better.
Okay, cool. Thanks. Cool. Give it a couple more minutes before we get started. And awesome. Hey, Holly. Good morning. Mr. Daraji and buenos dias. Hello, hello. BT, I unmuted your line, FYI.
Oh, you could hear me okay right now?
Yep, loud and clear.
Okay.
Matt Flores, you're working from home or the office?
From the office.
Yeah.
Baby.
How are you doing? How's your new house?
It's great. Everything's good. Just trying to work from the office, take our lives back.
Well said.
Another minute here and we'll get started. A quick reminder, if you don't mind keeping your lines muted while we're going. Obviously, if you have any questions, use the chat box. Evan Farley will be monitoring the chat box for us. We'll do a Q&A at the end. We'll get started here in another minute. Hey, Bill, we're up to 50 participants. Look at that.
I have 47 family members calling in from Czechoslovakia.
Bill, Daniel had a lot more people last week, just FYI.
Thank you, Gus.
Awesome. All right. Let's see, the numbers are still rapidly going up. Let me give it like 30 more seconds and we'll get started here, if that's okay. Gino is on. What's going on? Good morning, Anselm. Good morning, Jonathan.
What's happening, Jets? What's happening, BT?
What's up, Gino?
Good, man. Just trying to get through this thing and spending a lot of quality family time. So pretty cool.
I've been following that. You've been making some good food too, huh?
Yeah. That's why I'm not showing my picture, because it's all showing on me too.
Well, my father used to call that good living.
There you go.
Right. Well, we'll get started here. Welcome everybody to what we'll call episode number 5 of the We Fund LA Community Roundtable. And a special welcome to all of those who may be attending our call for the first time. This call has sort of evolved into something special that I don't think any of us could imagine. Our original goal was just to bring everybody together, create a platform where we can all share industry updates and collaborate on best practices. We secretly told ourselves that if we saw the attendance drop off, we would do the calls less frequently, or potentially cancel it. But we've actually seen the opposite. And I think we're all starved for information. I think we're all looking for productive time fillers, whether it's working on our CRM, connecting with past clients, or planning your post-COVID biz dev strategy, or jumping on one of our calls to hear from our industry leaders so that you can hone your skills and be of greater value to your clients. We're super grateful to have hosted some amazing speakers. And we wanted to take a quick moment to remind everybody of the amazing lineup that we have coming up for the next couple of Tuesdays. And we have next Tuesday, we have child psychotherapist and New York Times bestselling author, Dr. Tina Payne Bryson. She's going to be talking to us about parenting during the pandemic. Many of you probably know who she is. She's been featured on Good Morning America and NPR. We have the capacity for 3,000 attendees on these calls. So we encourage everybody to invite your friends, family, clients, or anybody who may find value in this talk next week. The following week, on May 12th, we just confirmed Brad Inman, who's become one of the leading names in real estate news, and we're catching him at the perfect time. Brad's been doing something called the Daily Dispatch, where he's been interviewing many of the industry leaders and CEOs of the top brokerages in the country. So we're getting him after all of those interviews. He'll be bringing all of that insight and knowledge to our call on the 12th. So we're really excited about the next calls that are coming up. A few housekeeping reminders again. Please keep your mind muted during the presentation. We'll have a Q&A session at the end of the call, but feel free to use the chat box at any point during the presentation if you have a question. And we do highly encourage participation. I mean, there's probably someone on the call that has the same question that you do. So if you have a question, please feel free to ask. If we don't get to it, you can always email any of the team members of the WeFund LA team, which they're all on the call: Leslie, Joanne, myself, and Evan. So let's get into it. Many of you are familiar with Civic Financial Services, which is part of the larger enterprise and a private equity group named Wedgwood, based out of Manhattan Beach. Bill Tessar, he has founded and served as president and CEO of 3 mortgage companies. He's been awarded the Glassdoor Top CEO Award and the Housing Wire Vanguard Award. On a personal note, Bill is affectionately known as BT or Billy when we're in Vegas. He's one of the smartest people that I know. I've come to him with some of the toughest challenges, both personal and business, and he's always got the right thing to say, and he's always got the right answer. He's not only a friend, he's a father figure to many people, and we're super, super grateful for having him on the call today. Bill, welcome to our call.
Thank you, Daniel. Thank you very much. Appreciate it.
So can you give everybody some perspective and a quick overview of Wedgwood and the different business channels that fall under the Wedgwood umbrella?
Yeah. So Wedgwood goes back 30 plus years. You mentioned it as a form of a real estate conglomerate. It is. At a very high level, they have purchased, fixed up, and flipped over 40,000 properties. So they have market reference and perspective. Their current run rate has been in or around 3,500 properties a year. I think they'll be about 1,000 off this year, just in light of everything going on with COVID. They acquire their properties through auctions, MLS, iBuyer, strategic partnerships, wholesalers, and off-market listings. And yeah, I think overall still very bullish on the market, given the situation that we're in right now. From Wedgwood, they have some offshoots to their flip business. They started a real estate firm that's also going through some changes. I think, Daniel, they've realized it only took them 2 decades, but they've realized that it might be better to partner with experts in the space than just trying to save a couple points on the listing fee. And so they're going through a maturation process of that. They own an escrow company, which is a DBO run. And they started Civic in 2014, which was really a spinoff of a conventional business that they owned, which Skyline, which I was a part of with you, Daniel, actually acquired that firm. And then when we acquired that conventional company, they pivoted and went into the private money space, which was really tail ended 2015-ish. Top 5 private money lender in U.S., did about $1.2 billion last year, specializes in bridge, fix and flip, some long-term rental holds, and a little bit of multifamily.
Excellent. Thanks for that overview. I mean, we've got a ton of our real estate partners on the call, many of whom work with real estate investors, people who do fix and flips, people who are into development. Talk to us about some of the biggest changes that you've seen in the private money space, in the hard money space, whether it's guideline changes, LTV haircuts. Talk to us about some of the biggest changes that you've seen.
So if you think about the private money space, I just recently put out a video, it was a short one, about kind of high level what took place recently back in the second week of March. And people have compared this event to the credit crisis, and it's everything but the credit crisis. And basically what took place over about a 72-hour period was a reset of the value of what a private money loan trades at. And so when you think about what that means, most people say, well, I paid a point or I paid 2 points and I paid X interest rate over this period of time. And that's the value of the loan. But the real value of those loans happens on the back end. And those loans are either are pulled together and sold through a securitization or whole loan sales or pass-throughs and a variety of other mechanisms. But what ultimately happened in a very short period of time is the value of those loans, which for the sake of an example, let's say a bridge loan was a 102, meaning 2 points over par, went to a 90 or a mid 80s. And so instead of making $200,000 on $10 million worth of loans that you would sell as a mortgage company, you would have to pay, in some cases, $1 million to get those loans off the books, which These are the same loans with the same people, with the same FICOs and the same LTVs, but Wall Street no longer had that appetite for that loan at that price. And it really created a tailspin in the whole private money market. And so what ended up happening, Daniel, we've talked about this a little bit, you and I, but as you guys experienced on the conventional side, a whole bunch of margin compression in relation to hedging costs and servicing values, we experienced the exact same thing in terms of a reprice on the loan. So a lot of these lenders that had a whole bunch of loans in their warehouse line got those remarked to market, and they had to make the call. And, you know, I've talked about it really in 3 different buckets. The first bucket is those companies that met the call, but then they had to retool the business. That was like a Civic. The second are those that are trying to figure out how to meet the call. You see a whole bunch of those tapes floating around on the secondary market being sold for cents on the dollar. And they've paused lending either short or long term. And then there were other companies that didn't meet the call, and those firms are no longer with us. And so, you know, what comes out of that is you have higher interest rates, lower LTVs, and guardrails around guidelines that were a lot more flexible the 7th of March.
Awesome. Thanks for that. I think Leslie, want to mute.
Bill, wanted to ask you, I know that, you know, we all talk about the iBuyer platforms, right? A lot of our agents have to deal with the Redfins, the Zillows of the world, and how they, you know, kind of go into our agent space. What do you see happening with the Redfins and the Zillows of the world, given that we've seen that they've kind of taken a backseat right now, especially with their business model and how they tend to pay out their employees in W-2 and in the environment that we're in? Give us a little bit of your point of view of how you see the iBuyer platform is transforming, or is it pausing on Redfin and Zillow's end?
Yeah, so let's first understand really what the iBuy platform is. It's really a low CapEx model, which is a paint and carpet model. Most of those big firms will not tackle the high-end rehab. And so they're looking for really those things that are middle of the fairway in terms of price and area constraints. What all of you should know is one of the biggest in the space, they would take 30 to 35,000 people at the top of the funnel in through the variety and various different ways of marketing. And then as they rinse through those with the areas and price and CapEx issues, what comes out the bottom is like 1,000 to 1,500 that they can execute on. And then a percentage of those go to the finish line, and then the other percentage is what they call walks. What I would tell you is the model didn't work quite the way that people thought they were. They raised a tremendous amount of capital, but their business is a lot like lending. And so if you just take the biggest out there, they would have big warehouse lines, and they would go and acquire these properties, and they would get financing on those properties. So for this example, let's say they got 75% of the value of that through a warehouse line, 25% their own capital. As that property sits on their balance sheet and doesn't come out the back end through their paint and carpet model, they start getting the equivalent of a margin call or an advance rate reduction. And so they were at 75, and in 30 days they go to 70, and then in 60 days they go to 65, which puts a tremendous amount of pressure on them to push that inventory out, even if they're pushing it out at a loss, which isn't the genesis of the model. The genesis of the model is to buy these properties, right, to circumvent the realtor, right, because they're going to save the seller money and they're going to still have a little bit of meat on the bone. The reality is that wasn't taking place. And Wedgwood has seen an awful lot of these tapes from these iBuy companies that have 100+ aggregates of properties that they've painted and carpeted, and they just can't move to sell at a discount. And so, you know, when I think about this, I think about, and I know Redfin's different, but I think about it as a tech play on the real estate market. and tech wizards are not real estate experts. And in the time I've spent with some of these big iBuys, walking through their beautiful 100,000 square foot facilities, it is a huge array of hundreds of IT experts, but very few people that really truly understand the nuances of the real estate market at the grassroots level. And, you know, to me, it smelt like a potential problem. And so, yeah, I think some of them will come back after this COVID, Leslie. They will. They have an awful lot of dry powder, but they got to get the properties that they have through the snake, and they got to get those things settled before they do come back. What I've been told is their model was 92 to 95 cents on the dollar. That's going to drop 10 points. And if it drops 10 points, then that's going to eliminate a significant amount of the iBuy opportunities that they're going to have in our marketplace.
Awesome.
My truth.
Awesome. Thank you, Bill.
Yes.
Awesome. Hey, Bill. This is a bit of a two-part question. Can you give us some context? You know, we've talked about on most of the calls, just talking about how strong the housing market was coming into this, coming into COVID. So what did the private hard money? What did that look like pre-COVID? And then what does it look like today? You know, if someone wants to take on a project today, and what's it going to look like, you know, tomorrow, and as we get through this?
Awesome question. Do you mind, Evan, if I just follow up on one other thing with Leslie, just a point of reference? So, you know, Wedgwood's in the space, right? And Wedgwood being in the space, we've looked at one of the biggest iBuyer portfolio of properties to purchase. We had 350 looks last week. We executed on 5% of those. So think about that. It was like 16 properties we actually bought off of 350 that they bought through that mechanism. So, I mean, if you just get that perspective of what the potential problem is for some of those iBuys and what they're aggregating on their books, it's significant. And now what's happening is they're taking these bulks in groups of 100 plus, and they're saying, you know, give us your best price. They'll write those off, and they'll get on to buying another day. I do think it's important to note that, you know, as a real estate agent, I wouldn't actually think about yourselves as competing with the iBuys. I'd think about it in terms of, how do I get my own iBuy? How do I get my own investor? I told Daniel this earlier, that the iBuy's been around 30 years. We just didn't call it iBuy. We called it Joe Guido from down the street that had a few $1 million that would buy a property at a moment's notice if it was priced right. And so the real good realtors always had one of those investors with a lot of cash that could execute quickly. If you really think about whether it's Open Door or any of these other biggies, it effectively is that. And so as a realtor, I just think you want to align yourself with the ability to transact. 9 out of 10 are going to be, you know, down the fairway deals. You're going to list it the way you're going to list it. You're going to market it the way you're going to market. You're going to do great things, and you're going to serve the client. But 1 out of 10 is going to have a situation that it's going to be a life event, or they're going to have high CapEx needs. They don't have the capital, and they're going to need to transact quickly. And I think you just need to, you know, figure that part of the business out. When you do, these other big players coming back in the marketplace won't be of any competition. So thank you for letting me go back on that.
Yeah.
So look, I think about the private money. You said pre, current, and post, right?
Yeah, exactly.
So pre, if you think about private money started middle double digits, 13 to 15%, 5 to 7 points, 50% loan to value. That's how it started years and years ago. And then it worked its way down because more people said, hey, I'd like to get a return on my investment. And they got involved, and every country club lender and someone that had a couple bucks in their pocket decided to be a private money guy. And then they would get a few more people and they would do it. And then Wall Street got involved. And once Wall Street saw that there was opportunities in this space, you know, they don't come on to any of these opportunities slowly. They came on rather aggressively. And you saw that in some of these acquisitions of lenders. But what it looked like, Evan, was 8.5% rate. This is where the market went. 8.5% rate, 75 to 80 LTVs, 100% of rehab funds, FICO's as low as 500s, hundreds of large, medium, and small companies competing for this market. Strong Wall Street contingency for warehouse lines and outlets, the whole loan sales and the securitization market booming, pass-throughs and premium sales booming, excess warehouse line capacity for everyone, right? I mean, it was good. And so, you know, first week of March comes around, COVID's part of our lives. What happens? There's a reset in Wall Street. Values of loans aren't the same. Today, you see interest rates 200 basis points higher. And that's for the people that are lending. For the ones that aren't, there is not a rate high enough that they could transact in because they have no place to put it and they have no place to sell it. 10% lower in LTVs, and you see some FICOs bumped a bit. There's guardrails around some of the flexibility and guidelines. At Civic, we did a $14 million loan in Beverly Hills a short while ago. You know, we will think long and hard before we'll go over 5 million until this thing settles a bit. 10% lower in LTVs across the board. That's the new normal. And there is massive liquidity and warehouse constraints today, massive. And it's created the problem that we're seeing with some of the competition out there. There's also a plethora of tapes that are floating around. And so everyone can get their arms around that. We looked at a $367 million tape. This was a tape of loans that were done pre-COVID. These are bridge and fix and flip, in and around the 8.5 to 8 3/4, in and around 75 to 80%. That tape will end up trading in the high 80s to low 90s. That means the owner of those loans, that's a $36 million loss on that paper. There's nothing they can do because they're not meeting the margins. They got to sell the paper to free up the lines. It's just they're in a quandary. And so there's tapes floating through the industry left and right like that. That's a big one, but they're all over the place. And then Evan, you think about what's it going to look like tomorrow, and this is the big question. My truth is less lenders because there's not going to be very many of those that were existing meeting the call. I think the bigger ones survive. I think the brokerage community survives. And others will just not have enough capital to be part of that industry. I think you might see some easing of LTVs. You might see some easing of rates. But, you know, the way I look at it is the market took leverage and WAC, or weighted average coupon, away from Wall Street for the last 10 years. They took it all back in 3 days. And they're not going to be very eager or enthusiastic about just coming back and you know, re-engineering an 8.5. I don't think we see that for some time.
Got it. And then do you see similar, you know, we talk about like a V or a U-shaped recovery on the conventional side. Do you see hard money coming back with it, or maybe as conventionals kind of gotten back up and running, private money maybe trails a few, 6 months after that, or do they kind of go hand in hand, would you say?
I think the survivors thrive. So the people that are going to survive this, they're going to mushroom. And I think the other ones go away. The overall lending pace or volume probably has dropped 10 to 15% if that's industry-wide. But I think investors just got to get their arms around the new norm. So if you were going into a deal on a $500,000 opportunity at 8.5 and now it's 10.5, that 200 basis points over a year is 10 grand. The opportunities in the real estate market are far greater than the extra 10,000 cost of capital. And so I think that's how investors are seeing it. And what I would tell you, I just pulled up a report before we jumped on here. In the last 15 business days, we've taken in 166 new originations with an average WAC of 10.51%, average LTV of 67%. So it does tell me that the market, it's a shock. So when you live in 8.5 and someone tells you 10.5, the first thing you do is you call bullshit. There's no way that could be true. I'm going to fact check this, fake news. I'm going to check it out. I'll find it. And then you start finding out that all your favorite lending companies are no longer lending. They're on pause. We're not lending right now. And then you go back and you go, oh my God. And you have to just do the calculator math to make sure that the transaction works for you. And what we're seeing from these investors throughout the nation is it still works, Evan.
Nice. And then my last question is, what should an investor, whether it's their first project or a seasoned developer, what should they be thinking about and maybe considering today that maybe they didn't have to consider before we got into this pre-COVID? Any extra maybe risk or something that they should be thinking about or taking into consideration?
Well, I mean, if you said like right now today, just knowing where contractors can and cannot work with some of the social distancing laws by county, I think that's certainly important, right? Because that's your dwell time or how long you're going to hold that asset. My feeling is if I'm a buyer in here, you know, I'm looking, my offers are 7 to 10% below what some of those opportunities are. We're seeing them trade in and around those numbers. So I think I would buy right. I would make sure I understood the working parameters of the contractors in that space that I was going to be buying that property. I would look, your rates conventional are the lowest in the history of time. My God, I can argue that you can overpay for real estate right now because of where rates are. There were four guys on our executive huddle that have purchased homes that have got interest rates in the twos. Like that's baffling for me. I've spent my entire life in this space in the twos. So you can make an argument around a lot of the noise of what's going on with real estate because of where rates are. And economically, if anyone does the math with a calculator, it's okay even to maybe miss on the bottom or maybe overpay a little bit on your real estate when you're connecting it with an interest rate as low as it is today.
Hey, BT, give us some guideline updates. Do you guys still work with first-time flippers, someone who's got their hands on a potential good flip or opportunity? Has that changed at all for the first-time investor?
Yeah, it hasn't changed at all. I mean, listen, part of our job isn't to just lend, Daniel. So when we look at a deal, we want to make sure it's good for the investor as well. It's not like do the loan, make the fee onto the next borrower. You want this person to come out the back end of this transaction and you want it to be good. So if you can give them good guidance, and remember, we do have reference. They've done it 40,000 times upstairs and we've done it just under 10,000 times down here. So we get to see a lot of the crap that doesn't make it to the finish line the way they thought it was going to. And we can help guide some of those, whether it's a first time, a second time, or a fifth time investor. So yeah, we do. There's tiers, there's 3 different tiers, and that would be a tier 3 investor. And of course, we still lend to them.
Awesome. I appreciate it. I'd love to open it up for any questions that anyone may have for Bill around fix and flip, iBuying. Go ahead and unmute your line if you have any questions.
Bill, I had a question. So can you tell us a little, we're seeing a lot of small businesses take out these small these loans. Can you tell us about the effects of obtaining small business loans that they'll have on like their ability to be able to qualify for private or hard money going forward?
Yeah, great question. The SBA has absolutely no impact on whether or not someone can qualify for any of our financing, and I'm not aware of any of our counterparts having a problem with that. I think the bigger thing people need to be concerned about, especially in the private money space, is deferment requests. On the commercial code, it's different than what you guys are dealing with on Fannie, Freddie, and Ginnie stuff. But if a current investor is in any form of deferment and asking for new credit, that's probably frowned upon. Like and listen, we saw out of I want to get my numbers right, out of about 5,800 loans, we saw 700 requests. But a lot of those requests are just to send the email. No one actually wants to support the request with hardship. And so like 83% of those requests didn't have any support, and it's a declination. The other 7 or 8% were approved with, and then 10%, we're still going back and forth with. So I think the SBA, no problem at all. Deferment, people need to think about that a little bit. Not deferment on a conventional loan and qualifying for a private, but someone that's in the private space. One of our customers that has a deferment on a deal comes back to us the next month while they're in deferment asking for financing. That's heavily frowned upon. That's my way of saying no deal. Good question.
Any other questions from the group? Not all at one time, please. Hold on.
Hey, Bill, I know that that you covered a lot already, but one of the main things is we're fairly bullish on appreciation for 2021. We think we have some depreciation and opportunity right now. We've been pitching that this is probably the best opportunity for investors to pick up property in Q3 and Q4, where there's going to be some fear, there's going to be some inventory, and we expect to have appreciation in 2021. Do you feel that that's the exact same projection that you guys have right now?
First of all, Gino, we're hiring, so I'll talk to you right after this call. Gino and I go way back. I have lots of admiration for Gino. So let me tell you what Wedgwood's seeing, because they have 1,800 properties at some various stage of the outlet. They're seeing the first time and first step up homes going for 100 to 104% of list. They're seeing the second step up is where they're seeing a little bit of a pullback, 3 to 5%. We think like South Bay, the bigger end homes, they've, they're high ticket items. So we thought that the pullback is like 7 to 10%. But if you're into real estate investing and you're not trying to get rich quick, couldn't agree with you more, Gino. And I can't overemphasize enough the cost of capital on the conventional side opens up the world in a way that it never did. If rates were 6 and we were in where we are right now, it would be a radically different landscape than rates being in the 2s where we are right now, because you can compromise a lot of the noise between your ears when you're looking at a 2 on your loan docs. It's just, I think it's the great equalizer to all the problems that exist, in and around COVID.
Yeah, we've been, Don and I have been talking a lot about buy and hold right now, right? This is the best opportunity ever for buy and hold. Yeah, there's still opportunity in flipping, but because there's a little bit of, value noise there, but buy and hold, what an amazing opportunity.
Look at our purchasing power we're going to have with rates being as low as they are. And I love that you hit on that, Bill. And the other piece I watched your video this weekend, by the way, nicely done.
Thank you.
The one key thing I love that you've always been strong on is those who are here to serve will get through this. And that's what all of us got to be concentrated on, is making sure we're serving our clients. And we're the ones that are going to come out strong at the end. And because we feel that the real estate market's going to stay strong for quite some time, mostly because rates are going to stay down for years to come. So I think actually we're heading into a housing boom for us, for a real estate boom, because the real estate market, Gino and I have been pressing a lot that the real estate market's the one that's actually going to pull us out of the recession this time instead of causing it. So we're very bullish moving forward. How about you?
Yeah, look, Don, I think if you want to find bad crap, just turn on the news. I think it's how you separate yourself from the bunches is by taking a different perspective and then getting your group behind that perspective and driving forward. I've been pro real estate my entire life through all of the cycles. I just think if you're trying to get rich quick, then you got to be right about a whole bunch of things. If you have a little bit of patience in this market, I couldn't agree with you more. And I know I've said it twice, and if I was on long enough, I'd say it 5 more times. Rates, conventionally speaking, are so low that it's game changer when you start thinking about the parameters you have. And you start talking about rental accumulation, even the rental rates are ridiculous. Long-term rental rates are, just think back in your entire career. Have you ever seen anything like it? It's unbelievable. So yeah, I like anything in and around taking advantage of where the conventional market is today, and acquiring real estate is in alignment. So yeah, I'm with you.
Be greedy when others are fearful, right?
I like that.
Hey,
Don't tell my wife that.
Someone asked about the video that we keep referencing. Bill did a really good 10-minute video just summarizing kind of the industry, where it was, where it's at today, and where it's headed. So I just posted a link to the video in the chat box if anybody needs it. Bill, where can people find out more information about Civic and about your group?
Well, you can go to our website. I think there's a number of people on the line, Daniel. Maybe we'll give you a couple links that you can send it to. At the end of the day, for me, it's not a time to sell. It's really a time to get behind others that want access to information in ways that they may not be getting it through their normal channels. Civic is doing incredibly well. We protected ourselves with this whole fiasco with forward commitments, so we didn't get caught up in the onslaught of massive margin calls. All of our forwards were settled, and we'll lend close to 80 million this month, which is off of our high, but we're still trying to figure out the new norm with 10 and a halves. I want to get a shirt like Getling's fancy one that says 10.5. We're in business.
Awesome. Before we let you go, any parting thoughts to our realtor community that's on the call? Best practices, what should they be doing today to prepare for post-COVID?
Yeah, I don't, we talked a lot about the iBuy, and you know how I feel about this, Daniel. I don't fear the iBuy at all. If I'm a realtor today, if I change my cap and I become a realtor, I just make sure that I have an outlet, and that whether that's a private investor base or JVing with an Open Door or Wedgwood or any of the variety of other ones that are out there, I just make sure that when I go to that listing appointment and it's that 1 out of 10 that needs to transact quick, that I have a solution. Because if I don't have a solution, then they're going to the internet, they're going to find a solution. And then I've lost that customer for life. And I just, you get so many bites of the apple, that would suck. And I'd say that would be where my mind would be if I was a realtor today.
Awesome. Thanks for that. Thanks for breaking our record. We actually did have over 100 people on the call, so you hold the record for now, but I think it might be broken next Tuesday with Tina. But thanks for being.
I'm going to have my IT make sure that doesn't happen. Brad Inman, 13 people. What happened?
Awesome. VT, thanks for being on the call today.
Thanks.
We'll forward any questions that may come after the call, and thank you for everything you do for us and for our group.
Thank you, guys.
Bill.
See you,
Bye,
bud.
Bill.
See you later.
Thank you, Bill.
Before we end the call, I know some of you may want to talk a little bit about wants and needs. Jan Amamian, I'm going to have you come on again because we're working with I'm not going to say a desperate buyer, but a buyer in need who's going to be having to move out of her rental here very soon. So we're looking for a specific property. Jan, if you want to.
Yeah, let me pull up my notes that she sent me. She sent me very specific. Let's see. So what they're looking for is up to $1,750,000-ish, right, Daniel?
Mm-hmm. Mm-hmm.
4 bedrooms, 3 bathrooms. They love Linda Vista. Looking for a single-story home because the mother is older and doesn't really want to deal with stairs. A pool would be nice, but it's not mandatory. And they would like it to be pretty much move-in ready. They don't want to have to take on any big projects.
Yeah, she was mentioning to me she likes that wraparound ranch-style home. And
yeah, she likes the mid-century, kind of the mid-century modern ranchy kind of house. It doesn't have to be super modern necessarily, but she does like the ranchy houses, and that's probably why she likes Linda Vista so much. There's a lot of those.
It's got to be a 1-story. Mom's elderly, but
Yeah.
there's plenty of ammunition at 1.7 with like 50% down. Strong buyer, can close in 30 days. So if anybody has anything for Jan's buyer, we'd appreciate
That's coming straight from Daniel's mouth, so we can be trusted here.
Awesome. Anyone else with any listings, any wants, any needs, any updates?
Daniel, I have one.
Hey.
Can you hear me? Also from Daniel's mouth and a client of his and mine. I have a 1031 exchange client, and the clock was ticking and we were writing offers and they're totally strong. It's just everything was going really quick. I think the 1031, and I actually don't know, Daniel, how far the extension got pushed back for them, but I know that it did, but they are really interested in like either a 2 or 3 bedroom, no pool, character, like they love Bungalow Heaven or Historic Highlands or anything like that. And they're like very, very eager. Like they write on everything. Not that they're not getting them, it's just that everything's been going really quickly and it's just been interesting.
Yeah, we saw a pretty big uptick. I think the first 2-3 weeks were this shock and awe period, but things have settled. I think people are figuring out how to transact in this new abnormal, if you will. And we saw an uptick in purchase transactions in the last 7 to 10 days. And hopefully you guys are seeing the same thing. And so we're hopeful that we're either turning a corner or figuring out a way to continue serving our clients despite, you know, all the madness. So anyone else with any listing updates, any buyer needs, speak now or forever.
Hi, this is Marissa with Mila.
Hi, Marissa.
How are you guys?
Good,
Let me
how are you?
park. I'm going to see a property, that's why. Yeah, we are buying. You know, our goal is to buy 6 properties a month. So if anybody has deals in the Northeast area or Pasadena, Altadena, we always buying. So just send it to us. And, you know, what we require is that to give us a price opinion as well. That's important, your opinion. And what you see on the property. And you can post my info, Daniel. But we look in and we also work with the listing to give them the listing back when they find a deal for us. So we try to do fix and flip that takes about 120 days the most.
Got it. I just posted your website in the chat box as well. Thanks for sharing that.
Okay, great. Thank you.
Anybody else? Cool. So just a reminder, guys, next week we got Tina Payne Bryson. We'll send out a specific graphic just with her information about next week's call that you can share. And we encourage everybody to send it to your clients. We're all in need of her guidance. I mean, I don't have any kids, obviously, but you know, even Chico drives me crazy sometimes, crying and wanting 100 walks a day because he sees that I'm home. But we all know we're in need of some love and some guidance. She's amazing. I've been following her now for the last couple of days, just trying to figure out what questions to ask her. But she's incredible. She's really a child specialist when it comes to, you know, she has this thing about the 4 S's. I forget what they are, but they're powerful, and she's going to be going over that to make sure that our kids are safe during this pandemic. So jump on next Tuesday, the following Tuesday, May 12th, Brad Inman. We look forward to seeing all of you guys. Thanks for jumping on, and we will see you guys soon.